Hello and welcome to Go Live. Today is Tuesday, August 4th. Hello, Sam.
How are you, Brent?
I'm good. It's always a pleasure to have you here with us. Thank you.
Thank you.
And if you're joining us either on Go Live or you're joining us on YouTube Live, you're in for a special treat. We have Chris Kelly, CEO and President of HomeServices America, and Gretchen Rosenberg. She's not only the President of Kentwood Realty in Denver, Colorado, she's also the Executive Liaison for Industry Affairs of HomeServices America. And they are going to be sharing with us our mid-year update, National Housing Outlook. Great publication.
Great document.
Great document. And chock full of information that's going to help you sound even more informed and intelligent when you start answering some of your clients' questions. But before we get to all of that, that's because we want to jump right into it. Sam, you have a couple ASA announcements and reminders for our agents.
Yes, a couple of reminders. So your public domain emails, right? I know I sound like a broken record, and forgive me for this, but it's important for you to recognize that if you're using a Gmail account, so an @gmail.com, @Yahoo, @Hotmail, Brent, God forbid, @AOL.com.
I can hear this sound. Yep.
Yeah, you know who you are. There's a few of you out there still. You have to be very, very careful. One, you should be changing your password on a regular basis. You should have the two-factor authentication where you have to be text a specific code to log in. And I'm reminding you of this because these are the protocols that we have set up with our @BHHSCal.com emails. You've all been issued an email address by the brokerage, and the best practice and our preference is that you use that email address. So if you haven't used it in a while, I want you to dust it off, get to know it again, because
why is this important?
The maestro that is coming is one of the big components of that. That's how it's going to authenticate you. But more importantly, the amount of security that is behind that email address is unmatched when you compare it to the public domain email domains, right? That you're @Gmails and everything else like that, right? Unfortunately, recently we had an agent, not in a sale transaction, but in a lease transaction, actually have their Gmail account was compromised, and the bad guys were following that account, and they were sitting and waiting, just looking for keywords like wires, right? Deposits, things like that.
Escrow.
And sure enough, because our agent, in really good faith and in good spirit, was facilitating some money transfers between a tenant and a property owner housing provider. And because they were involved in that kind of communications, they were able to intercept that in that process. And as a result, there was a good chunk of money that is now gone.
Yep.
Right. And so those are very difficult circumstances. And unfortunately, that particular agent not only didn't make a commission on that transaction, but also cost them quite a bit of money because they were involved in that transfer. All right. So I don't want that to happen to you. So you got to make sure that you have those two-factor authentications. You got to assume, let's just assume that your email account has already been compromised and that there are people in waiting looking to do bad things. So we're never going to have those conversations about wires over email. If you at all are, make sure that you're involved in a protocol where there's a phone call first. We're making sure that we're confirming numbers. Even if you have to get people on a three-way call, it's all to protect our clients' money, our clients' accounts, and everything like that. So please, please, please watch out for that. But more importantly, just use our company domain. Right. We have an army of security people behind us, both at our company level and at the HomeServices level, and even beyond that. And so that army is there to protect you, more importantly, to protect your clients, right? Yeah. And that's who I think we should make those decisions from that vantage point, right? The last thing I want to share with everybody are the CIPA requirements. This is for California, it's the California Invasion Privacy Act that was passed a long time ago, but it continues to have multiple iterations as we are here today. But what we're seeing right now are a number of claims against a lot of companies, not just us, but with regards to the website and with regards to data and how we store those data, right? So the one thing I want you to be aware of, and Chris, if you don't mind bringing that website up, that would help me tremendously. So on your agent websites, what's really important is that your web provider, whomever that is providing these options. You know how when you go onto a website today, Brent, you have to accept the cookies and you have to accept all these tracking. Well, this has everything to do with the Privacy Act. Okay. And so there's various forms of this, but what you have to know is that on your agent websites, it's important to make sure that this step is embedded in there. That's one of the first things that they're really looking for. And as they dig through your protocols and your Privacy Act policies, they're looking for ways to issue some claims.
But if they have a company provided, if they're using one of the company websites, it's already taken care of.
Yeah, and so as you move forward, I really want you to start considering, we have some amazing, thank you, Christina. We have some amazing tools that are coming to you in the last quarter of this year with regards to websites and a completely integrated system that you saw Brent and I come in and pitch to you earlier this year. That's coming to you very, very soon. And all of these protections and protocols and policies are already built all into it. So before you sign with another new web provider, your current one, make sure that they're providing what is necessary. But before you sign with someone else, take a look at what we're going to be offering you here really soon. Because not only do I think it's better, I think you're also going to be better covered as well. So enough of my boring stuff. There you go.
Okay, one more announcement before we get to the topic of the day. If we could pull up the one slide. I want to remind everybody that on August 6th, our Rethink Council is going to be doing something that I know you and I talk a lot about, and that's business planning, right? And it's never too soon to start talking about business planning. In fact, I know a lot of our very productive, very successful agents start talking about the next year in September and October, believe it or not.
Yes.
So I think it's very timely that our Rethink Council is going to be talking about how they plan to dominate 2027, and they're going to talk about it on August 6th. So we're fortunate. Yes, thank you, Christina. She's put into the chat the link for you to register. So please go ahead and register today. That way they will send you a reminder between now and August 6th, and you'll be all good to go. Probably third from the bottom is our Gabby Hussein. She's out of our Santa Barbara office, and we're so grateful and excited that she is on the Rethink Council this year.
Shout out to Gabby, Santa Barbara.
Shout out to Gabby. She's doing a fantastic job. So please tune in and find out how these young, successful agents are planning to dominate in 2027. And then take that information and then sit down with your branch leaders, sit down with your team leaders, sit down with Sam, Christina Miller, our director of training, and start planning your 2027. It is never too early to do that.
It's actually only 120 days.
God, remember we used to count down the number of days to the new year. Thank God we don't do that anymore.
120, I just calculated it the other day, 123 real estate working days left is what I call it, because I include Saturday.
Yeah. No, I'm surprised you don't include 7 days. knowing you and your work ethic. All right. Anyway, so please join in for that. It's going to be a great podcast. So without further ado, let's bring on to the conversation. Let's bring Chris Kelly, President and CEO of HomeServices of America, and Gretchen Rosenberg, Executive Liaison for Industry Affairs for HomeServices America. There they are. Hello, Chris.
Hey, how are you? It's great to see you guys.
And there's Gretchen. Thank you both. Both of you are responsible for this wonderful document I hold here in my hands, the HomeServices Mid-Year National Housing Outlook. And I think this is a follow-up to the housing outlook that we launched at HomeServices at the beginning of this year that we're so grateful and incredibly proud. Gretchen, I know for you, this has been a project near and dear to your heart. And I know you're very proud of the fact that we get this out probably faster than anybody, right? Early January, you were out with this. Here we are in July, August, and you're out with the mid-year review probably before anybody else. So congratulations. It's a beautiful document, and it's filled with very timely fact information that our agents are going to be able to pull from directly. So you're here today to help us understand, Chris and Gretchen, why this document exists, why it's so important, and what's inside, and how our agents can start utilizing it right away and have conversations with their clients.
Yeah. And then Gretchen, are we allowed to share your news? I mean, is it live? It's live in your market, right? So,
Sure. Let's hear.
Hey, breaking news,
breaking
right?
news?
I mean, this is the
Wow.
news
Okay, we have a sound effect for
that.
that.
Gretchen actually, and this is exciting. I get to kind of introduce this. Gretchen actually is transitioning to a full-time role within Home Services as our Vice President of Industry Affairs and Engagement. And so obviously you saw the work product she's created. There is so much going on in our industry right now that we need someone that is their mission, that is their job. And Gretchen is 1,000% the right leader for that. So I know that you had told your local folks in the Denver market earlier, and so we can share the news with everyone in California now as well.
I'm glad you told your local folks, Gretchen, because this is on YouTube Live. So now everybody knows, no secrets.
The PR comes out tomorrow, so Home Services is sending out the official public announcement tomorrow.
Well,
but her folks know about it, so I feel like it's safe to do. You know.
Well, thank you for dropping that news here on California Properties.
Yes.
I just updated my notes. Yeah, we got the scoop.
You got a scoop.
Vice President of Liaison Affairs. Thank you very much. So, all right, awesome. Yeah. So let's just jump right into it.
Gretchen can jump in here too, but we thought about the mid-year report was a lot's changed. A lot changes every year from what you kind of put out in January. But certainly this year we saw some pretty dramatic, let's say, global events that had an impact on the real estate market. And we decided this was a good opportunity to put out a mid-year report, not just to regurgitate what we did in January and then but here's the newest numbers, but really to kind of look at it from a different lens as far as like how it's impacting consumers and things like that. And so Gretchen, please weigh in a little bit too, kind of the thought process behind the mid-year as well.
Yeah, I mean, this was very collaborative. The first report, I kind of just wrote it and then threw it out there and said, okay, what do you guys think? And this time Chris and David Childers and I met ahead and talked about how do we want to frame it. And we really wanted to make it more, less about the data, although the data is really robust in here, thanks to Keeping Current Matters. But we wanted to also make it provide talking points to our agents on how to discuss these issues with buyers, with sellers, when they're out there in the community. And so we framed it more along the lines of what does this data mean for the consumer?
Great. Yeah. And so I want to make sure our audience recognizes that a lot of the data was from our data partner, David Childers from Keeping Current Matters, right? So very reliable source that we utilized.
So I know I'm going to go ahead, if you guys are good with it, I'll go ahead and share my screen, and we've got some of the slides that are taken from the actual report, and we can kind of go through it here a little bit, and I'll kind of share some commentary a little bit here. I'm going to maximize this so it actually looks good. How's that looking, Sam? You're the expert here.
It looks great.
All right, Sam, you always every Friday you manage to make Jimmy and I actually look decent.
Well, today I all the credit goes to Christina behind the scenes, Christina Miller. It's really not me. So actually, I'm scared now because you're probably she's smarter and better looking, so you're probably going to get rid of me here pretty soon. So
no comment. No, not going to do that. I think one of the biggest questions, that Gretchen and I have gotten, it was really about rates. It's the first number everyone looks at. And, I think what's helpful is sometimes we view any stat or any number kind of in a vacuum. And I think it's always healthy. We bring this one up a lot. And yes, you can see as you go to the right side that we have seen certainly since 21 and 22, we have seen a rise in interest rates. But if you go back to 1971 here, so we're going back over 50 years at this point, you can see we are not out of any type of historical normal range. If you drew a normal line, we would be about where it is if you average this all out over that 55-year period of time. And so, yes, what we haven't seen very often is a change that we see from you look at that trough of 21 to the top of 23. That was unprecedented to have that kind of a dramatic change in rates. That was the shock to the system, right? Jumping into the 50-degree water, the cold plunge a little bit of what really shocked everybody and kind of caused the market to take a real step back for a moment. But from a historical perspective, we are very much in a normal range. And I think it's helpful that we in the profession provide that perspective to our consumers, because this is where it gets lost sometimes. You still have people out there thinking, well, I need to wait till it gets back to where it was in 21 and 22. It's not coming unless there's something really bad that happens. So, I'll let you guys kind of comment on this too, but I always like to kind of start with this more broad picture of where things have been to give you a better understanding of where things are today.
Right. Well, I've heard you talk about like something really bad would have to happen in order for it to go back down to those industry level lows, like the 3%. And none of us want that really bad event to happen, right?
I don't. I mean, it was, 2020 and 21 was fun for, but no, I don't want to go through that again. And I don't think most people do either.
No.
And really what causes the difficulty is the volatility that happens. That's what really kind of puts people on the sidelines is it's not necessarily what the rate might be or what the numbers are. It's really more of the volatility that causes people to step back because it's changing, on a day-to-day basis as if it's the stock market or something.
Right.
Gretchen,
Well,
what do
okay.
how do you kind of approach it with your professionals that you coach?
Yeah, I mean, I think I'm old enough to remember the really high rates. I bought my first house and assumed a 9.5% loan, and we were like, woohoo, that's amazing.
Yeah.
But if I talk about that with our younger agents and younger consumers, their eyes sort of glaze over. They're like, that's not relevant to me. And so I have found that comparing old rates to them isn't as tangible as explaining what the cost is to you if you don't buy a house, if you're able to. And I know Chris is going to get to that later in this conversation, but because he has a really good way of explaining it and it's very passionate. But if you can afford to buy a house, don't wait for 3% and don't listen to me talk about my 9.5% rate, because I don't think it's going to go there either.
Right. Right. Well, Chris, I'm glad you brought this slide up because I've heard you talk about this before. And I think you have a really great way of explaining the difference between, the relationship between the 10-year treasury and the mortgage rates and how that impacts the consumer and how that doesn't really, how we can explain it to our clients in simple terms and how it affects it.
It's a great question because we spend a lot of time talking about what's the Fed going to do? Is the Fed going to raise rates? And a lot of the consumers believe that if the Fed does something with rates, that is going to immediately has it like they're raising mortgage rates. And those two things, there's some correlation, but there's not causation there. And so really, if there's a number you want to look at on a daily basis in the profession is I always start off every morning and I go, where's the 10-year at? So the 10-year is the 10-year treasury note. And what happens is going back to 1971, the 30-year mortgage and the 10-year treasury note move in unison. And you can see it. You can see this chart, right? When one goes up, the other one goes up. When one goes down, the other one goes down. Now, what changes over time is what we call the spread, right? Is the spread between the two numbers. And you can see that on that historical basis too. Sometimes the spread is bigger, and sometimes it's smaller. And so really what I wanted to kind of show you guys is that typically the normal spread is around 1.8%. So call it 2%, right? In times of volatility, the spread expands because they have to have risk built into it. So as you guys know, if I take out a mortgage on a house and I want to pay it all off, I have a 30-year mortgage, but I want to pay it all off in 3 years, there's no penalty. Like it's illegal to have a penalty for me paying off that mortgage. Why would there be a penalty? Well, because the lender they made the loan on the assumption I'm going to get a certain amount of interest rate over a period of time. And so when I cannot charge a pre-penalty payment like you can in the commercial world, I've got to build in that risk factor. So the risk factor would be is that do we think rates are going to dramatically come down and this loan could get refied in the next 4 or 5 years? As that risk goes up, the spread goes up. As the risk is normalized, you see the spread return back to that, let's say, average 2%, type spread that happens in between it. And so here's all we're looking at right here is just the 30-year fixed and then that 10-year treasury. And you can kind of see what happens when we started off the year trending down, and we got down to I think the treasury got down to about 3.9. The 30-year fixed was at 5.99999. And then the next day, the global conflict in the Middle East arose. And you can see what happened in that middle line. Things started kind of going back up again. And so, and what I've overlaid here is mortgage applications, which is the green line. Mm-hmm. And really easy here to see. As the blue line and the orange line, so the 10-year treasury and the 30-year fixed started going down, the green line started going up, right? Mortgage applications started going up as the rates came down. As those numbers started going the opposite way and they started going up, the green line started going down and mortgage applications started to fall a little bit. And then we had the first announced ceasefire in April. Numbers trend the opposite way. And we've played this domino game ever since then of ceasefire, not ceasefire, ceasefire, not ceasefire. We're currently in the mode of there's a ceasefire and there is a potential deal being worked out. I hope it holds this time. It would be very good not just for the real estate market, but it would be good just for the broader economy and for inflation as well, for energy prices, which are a big driver of inflation. So this is really it is. And so what I'd like to show is that it could actually be worse, because if we had the same spreads that we had in 2025, so if that risk factor was creating the spread even more, mortgage rates right now would be almost 7.3%. And if we had the same spread between the 10-year and the 30-year fix that we had in 2024, the mortgage rate would be almost 7.5%. So that's the impact that the 10-year has on the 30-year fixed, and that spread between the two based on the risk factor. So the spread has really been the hero of the last, let's say, 8 or 9 months in keeping rates in the 6% ranges, as opposed to jumping up into the 7% ranges, even with the 10-year exactly where it's at right now. That spread really has a big impact.
But haven't the risks from the lender's point of view, haven't those the investors, haven't they still been, aren't they the same? Weren't they the same this part of the year as they were in 2025?
No, because if you look back, actually rates, I mean, we just over the last week when things really, and then they went back down again, but last week we hit rates that were like the same that they were in 2025. But before that, while rates might still have been in the sixes, they were lower than they were 12 months period, prior to. And when we get kind of further into, let's say, the rate projections of what we're looking like, what we think mortgage rates will be over the next 2 or 3 years, what you'll see is they're not dramatically different than what they are right now, right? Somewhere probably in the 6% range, which means there isn't as much risk factor from the lender's perspective of like some calamity coming in, mortgage rates are going to go to 4% and everybody's going to refi. So I've got to build in that risk factor right now. So we're really actually in a more stabilized environment, even if it feels like we've kind of been going up and down based on the news cycle.
Interesting. Okay. Thank you, Chris. You
bet. And so this is kind of the forecast as we look out, right? And we shared this when we were working with David as well too. We tend to look at a lot of different forecasts because they all have kind of their own, I don't know, let's say biases in there. NAR is always very optimistic, for the industry, which is great. MBA is trying to make the mortgage bankers feel well. We look at Fannie, we look at other banks like Wells Fargo and stuff. And so what we see is you can kind of see a range, and it's actually not that dramatically different. You can see from Wells thinking rates in the 6.2 range up to, MBA forecast of 6.5. And so again, nothing really dramatic. No one's predicting 4% and someone else is predicting 8%. Everyone's really kind of feeling like we are in this kind of 6%, what I would call normalized range, for a period of time. And just to kind of show it in a different way, you can kind of see it here, just kind of stated out the averages, and you can look from Q3 of 26 all the way up to Q2 of 27. And you can look at the averages there and stuff. Again, 6.33 to 6.42, depending on which one you're looking at.
What I'm not seeing are any fives.
No, and it's not to say that it can't happen, right? Because certainly, let's say if there truly is a peace deal and the conflict in the Middle East is fully resolved, and the Strait of Hormuz is now flowing again with all the energy that needs to come through there, and energy prices come down and gas prices stabilize and all those types of things. And there's less concern about inflation, and maybe the Fed doesn't need to hike rates and things like that. There is a possibility that we could get into 27 and start off very similar to how we started off 26, which is this general trend down a little bit. Again, not dramatically, but maybe a little bit. But if you notice, I just went through a lot of ifs in order to get there. And none of those I'm willing to put a lot of money on. And so again, I think this is kind of our normalcy that we should kind of expect. And rather than wait for the market to come to us, we need to go out there and engage in the market as it is.
Do we want to talk now why a buyer may not want to wish for and wait for rates to get down to the 5? It might not be in their best advantage.
Yeah, no, that's great. And Gretchen, why don't you kick that off, and I'll go to that. I'll go to that slide.
Yeah. I mean, I think this is a great example of how your agents, Sam and Brent, can use some of the data or the examples in this report and then do these calculations on their own with their own average price. So if you say to your client, if you bought a $400,000 or $500,000 home, let's just say, and put $100,000 down, and if the rate were where it is today versus where you'd like it to be, let's do the numbers. I mean, you all have mortgage calculators on your phones, right? So figure that out and show them the difference. In the example we use in the Housing Outlook, it's $257 a month difference. And then you say, okay, well, what if houses are appreciating modestly, 1.7%? You've missed out on that appreciation and the equity you're building by paying your mortgage, even though in the beginning it's largely not principal, you're still paying down your mortgage. And so you can run these numbers for your clients and really make it tangible for them why they should be buying if they're able to, as soon as they can.
Yeah, this is one where you can take this chart that you're currently seeing and like the one that was in the Outlook as well, and you can customize this so hyper locally, right? So
Yes.
whether you want to do it to a zip code, you could do it to an actual neighborhood if you wanted to, because within the neighborhood, you all have access to what the homes have sold for now versus a year ago versus 24 months ago. And you can project that out. And yes, there are some markets in the US where we are seeing, let's say, price, like let's say flatness or even maybe a little bit down. The
Yes.
vast majority of US markets are still actually seeing price appreciation. Thankfully, not 12 to 15% a year like we had before, because that was really causing many of the issues we're confronting today. But back to that normal range of, like, Gretchen said, 1.7% up to 3 or 4%. And so when you only look at the mortgage rate and you say, well, I need rates to get back down to this, you are assuming that home is, one, going to be the same price a year from now or 2 years from now when that rate is at whatever magical number you hope it to be. And then two, if the rate really does get to that, how many other people are now competing with you?
Yes.
Because they did the same thing in order to get that same house. So the chances are, more likely than not, the price of the home is going to go up, even if it's just modestly. That's what I like about the one we're showing here. These aren't crazy numbers. This isn't like, oh, it's going to be worth $600,000 a year from now when it's 400 a day. It's 400 to 412, right? And you can see the difference and stuff is that, if even at a 6.25% rate, if it's at 412, your monthly payment has actually gone up $9. And so you cannot look at any housing stat simply in a vacuum. You have to factor it into the entire equation. And this is one that I would use very hyper locally with consumers that I might be talking to that are thinking, should I or should I not engage in the market today?
Yeah. One of your quotes from the report says, waiting for a lower rate to save $257 a month can end up costing $20,000 in missed appreciation and equity. Rate drops are recoverable through refinancing. Lost home value is not.
Yep.
That's right. But I would also say, I'm going to guess that you have a fair number of cash deals in your market.
We do.
Having grown up out there, looking at your website made me homesick to see all
Come home, Gretchen, come home.
But even with cash buyers, I think these conversations are super relevant. You're not going to talk about rates, but you could talk about what is the cost of the money. What if it's in a long-term, like a high interest savings account right now? How much interest are you making versus what your appreciation might be? And oh, by the way, you also need to pay to put a roof over your head. On some level, you're going to be paying for housing, so you might as well purchase the house that you want to be in, pay that cash for it, and then the money is working for you because you will be getting appreciation.
Absolutely.
Yeah,
and the same thing with a cash buyer is your competition in the future may not all be cash either, right? It's
sure.
So even though I'm a cash buyer, why do I care about mortgage rates? I can wait. Well, the problem is if rates, let's say, do from 6.5 to 6.25 or 6, and that spurs on more activity, that is going to mean more competition for those properties, even with you as a cash buyer. That's still more people, looking at that property or taking inventory off the market that you might be interested in.
Exactly.
Yeah. My father always said, you should buy a property the moment you can actually afford it, because he gives the analogy, what he paid in, I think it was 1971, when I was originally born. And he's like, you'll never, ever be able to pay those prices again, ever. And 10 years forward, when they bought their second house in 82, you'll never pay those prices ever again. And you keep fast forwarding every 12 years or so, and you have that same conversation. And while real estate is going up and down, it's going up and down at an increasing rate, right? And so it's like, he always said, I tossed and turned every night before I signed those papers. How am I going to afford to make this payment? The reality is that you figure it out and you make it happen. And there's a reason that real estate is the number one investment for most families, right?
Yep, that's exactly right. Well said by your father. I use that line frequently, and I will credit him for it, because that's my answer too. Is like when someone asks, when should I? The second you can afford it is when you should buy a home.
Absolutely.
Now, this is kind of looking at it on the flip side of like where the seller mentality is a little bit too. And Gretchen, you do a good job of covering this one. So I'll let you kind of maybe kick this one off a bit.
Yeah, thank you. Well, I feel like the sellers just they want to kind of stay anchored in the past, and they're using ChatGPT and Claude. They're really using AI a lot. We're finding that in our market, and then they're coming to our agent and going, ChatGPT told me this, and so it's excellent when the agents have the data to be able to respond to that. And maybe you guys even run some of these questions through ChatGPT yourself so that you know what it is your clients are seeing and reading. But what I like to say is if you overprice your house and then you have to start reducing, and I know, Brent, you like this term, and I used to use it with my clients when I was still an agent. It's like you're behind a rock that's rolling downhill and you can't get back out in front of that rock. And so that rock is rolling downhill and you're doing price reduction after price reduction now because you didn't price it correctly in the beginning. And I think that you end up, we know that you end up losing money. You sell it for less in the long run than you would have had you priced it correctly. And the other thing that came out in this report that I thought was really important to emphasize is now you end up with the buyer pool that is not your outstanding buyer pool. You've got the buyers now that are kind of the bottom dredgers or whatever you want to call it, the ones that are really looking for a deal, the ones that are going to negotiate really hard. They're less emotionally invested in the house than someone who sees it right away when it comes on the market the first few weeks. So help them correct their expectations. And these charts you just show it to them.
Yeah, and I think the thing to look at here is it would say, if you look at where 2025 ended up with and 26 about the same, look at 2018, 2019. We're just back to normal, right? Like it's not bad. It just means we're back to normal of like what typically happens when you list your house. And it could say sell for less, but it could still be 98.5 or 99% of your list to sale price ratio. But that's pretty normalized to see. We've just kind of returned to a normalized market here. But what we know is that consumers are always lagging reality. And so what we're seeing here on the left versus the right is that 83% of the sellers are still living in a world from a couple years ago because they remember what happened to their neighbors or whatever versus the reality they're living in today. And I think one of the biggest things we do as professionals is manage expectations. Yes. We set expectations correctly with our consumers so that, again, we don't bring surprises to them. They don't wonder why their house didn't sell because based on how they wanted a price and we just capitulated to it, or we didn't try to at least educate them in the process.
Right. I know our listing agents, the conversations I'm having with them, I know you are too, the ones that are taking the time at the listing table in the kitchen to have those elongated conversations, those really heart-to-heart conversations, those sometimes difficult conversations, are having their homes come on the market priced correctly. And they're the ones that are going into escrow. And the ones that are maybe, like you said, capitulating and having just a quick conversation, they're accepting what the seller wants to hear. They're regretting it because those are usually the difficult listings that are having to have price adjustment after price adjustment. And then they're behind the rock, rolling down that hill.
They're behind the rock. You also have so many micro markets where you are. In San Diego is behaving very differently from Montecito. Yes. The OC is different from LA. And so just knowing those specifics is also important. I mean, I'm not telling anyone on here anything they don't know, but you got to know your micro markets.
Yeah. You're absolutely right, Gretchen. So where we're broadcasting from now is in downtown San Diego, which if you're looking for a downtown San Diego condo, we've got a great deal for you. There's some really good opportunities here in downtown San Diego. But if you go 2 hours north to downtown Los Angeles, it's a hot commodity. Like people are standing in line to get into one of the downtown LA condos. And some of these condos that are being built in neighborhoods in and around downtown LA that historically
I wouldn't go into.
No one would even dare to go into those neighborhoods, and these beautiful towers are being created there. And so, and we're only a couple of hours away, which is really, really interesting. So you're absolutely right, Gretchen. And then if you swim across the bay from us, like literally just walk out our door, jump into the bay and swim across, which I know you can do, Gretchen.
You could buy a $14 million or $15 million estate.
We just, one of our agents just listed a $15 million estate, one of those ones, Gretchen, that is in Coronado, on the west side of Coronado, facing across the bay, facing downtown San Diego. So that amazing, spectacular view.
Correction, you can't buy it.
The east side of Coronado, if it's facing back.
It faces back to downtown, and you can't buy it because she priced it well, she staged it well. It's already in escrow after 1 week.
Sold the day that we had, or she had the broker open, and we all went, and it sold, literally sold that day.
I saw that on your social media. That's phenomenal.
It is
a good
phenomenal.
Broker. You know how to do your job.
Yep.
Yeah, I mean, that kind of, Brent, we were engaging an email ahead of this call, and you had talked about, the term aspirational pricing. And really, when you use that term, you're basically saying, I'm going to hope and pray that there's a buyer out there who has an idiot for representation or no representation at all, and they're going to fall for this.
That's exactly right.
So as a real estate professional, when you're talking to a seller and they talk like, look, we have to assume the buyer who's of a caliber to buy this kind of property is going to have smart representation on their side. And they're not going to let them just overpay unless there's a competitive situation going involved. And then, emotions can kind of get involved, but you don't get to competition until you're priced correctly and you're bringing in the crowds, So, yeah.
Absolutely.
Aspirational pricing. Oh my gosh.
Aspirational.
And then this is, we can cover this one quickly because Gretchen hit it, but this is the chart of the rock rolling down the hill that you're trying to get out in front of, Indiana Jones and, Raiders of the Lost Ark, where you're trying to jump out of the tunnel with the ball chasing you. I mean, this is what happens, when you start off on the wrong foot.
Yep.
Yeah. And then, one of the big, obviously, challenges, because we've now talked about rates and we've talked about pricing a little bit and stuff. The other issue really obviously is the affordability challenges and stuff. And so what we see happen is that, as that line comes down, we get into these, the median line of affordability, and affordability is not just housing, it's wage growth, right? So is housing outpacing wage growth? We're actually now at a place where wage growth is outpacing the inflation of home prices, which is good. That's where we want it to be. That's why we say a good stabilized market is home price appreciation around 3%, because at least wage growth is keeping up with that or exceeding it. And that's what we want for those future homeowners that will be our clients of tomorrow.
Exactly.
Is really what we're after and stuff. And so for the next 5 years on that pricing, this is again, this is national. So and why do you look at national if everything's local? You look at national because oftentimes your clients are reading the national headlines when it comes to housing.
Mm-hmm. That's right.
And that's what they're seeing. And so you got to be able to address the national headline and then bring it back down to what may be happening in their community, their neighborhood, their city. So what we really, as we look out, no one's projecting anything massive. This is just really a return to normalcy as far as what we would expect from home price appreciation between now and 2030. And if this was how it would play out, that would be really great news for everybody, because when it goes much higher than this, we just continue to price more and more people out of the market. And it kind of just is like gumming the gears as far as that future housing market goes a little bit and stuff.
And that's a chart that you can also show to buyers who say, well, aren't home prices going to crash? Look at inflation, look at the news, home prices are going to crash. I'm going to wait for that, aside from waiting for rates. Show them this and that, it really, most economists say we're going to have appreciation. It might slow down a little, but it's not going to stop.
Mm-hmm. Real estate doomsdayers have had a difficult 10-year run, because from 2016 till today, almost every other swipe on social media, I'll find one yahoo who's on there saying foreclosures are going to decimate all of Florida.
REO tsunami
is going to have the worst crisis ever, right? Like you would think that they would find a timeline in that 10 years where they were going to be correct, but they still aren't.
One of my favorite follows on socials and then also like on podcasting is Logan Motashani. He's with Housing Wire.
And
he takes on those doomsdayers a lot, like, almost like WWE style. Like he's like, none of them actually show their real face on their avatars on social medias, like it's never a real person who's wanting to claim it. But you're right. And Gretchen, I'll let you touch on this too, because one of the reasons why it's very hard to have a crash is because of where we're at from an inventory perspective, which again, national numbers, but obviously highly localized as well.
Yeah.
Mm-hmm.
And you can see we're trending up, but if what the doomsdayer will show, Sam, is they will show 22 to say 26 of May and go, oh my gosh, look how much inventory has gone up, between that period of time, as if we were starting from normal and now we're outpacing it. And we're really not, we're just getting back to 2019 levels. And we've got some maps here that'll kind of show that too. This was a new one that our friends at Keeping Current Matters came up with this year, which I really like, which is just kind of a bar graph way of looking at seller's market to buyer's market. And you can see that in 21, essentially the entire country was a seller's market. And as we get now into 25 and then into 26, what we're seeing is that it really does depend on what market. And like you all said, you can have downtown LA be absolutely still a seller's market, but then Orange County could be more of a buyer's market at this time. We're just seeing that kind of return to balance between the two. When any of these get too out of whack, it can be really good for one side for a period of time, but you're going to pay the price for it. And so as much as that wave in 2020 and 21 was great for sellers, we're paying the price for it now, which is why, balance and harmony in the market is way better than these kind of individual disruptions that we get from time to time, where it really swings one way to the other.
Absolutely.
Yeah. And so this is where the inventory kind of comes in. You can see California is still really not back to 2019 levels. I'm sure you've got pockets that are, but overall as a state, still 10.5% less than what you had in 2019. And what we forget about is that, and Brent, you might remember this. I remember going to HomeServices meetings like in 2015 and 2016, where Ron Peltier was saying, we have an inventory problem, within the United States. And so we keep pointing back to 19, but even 19 was a period of inventory decline from 16 to 17 to 18 to 19.
Yes.
And so just getting back to 19 isn't some magical number we're hitting at. We were actually in a declining inventory level even before COVID happened a bit too. And Gretchen, I'm not sure, like in some of the markets, Colorado and others, you can see Colorado is a lot higher, but I'm sure pretty pocketed in those markets as well too.
It's super pocketed here in Colorado. And also I think that it's not a bad thing to have more inventory. I mean, we don't want to have a catastrophic amount of inventory, but that last chart you showed just perfectly balances the yellow and the blue show. That gives buyers more time to think. It gives them more time to shop. That craziness that we had post-COVID was just not sustainable and not normal and super stressful. We had agents who worked 7 days a week, 365 straight days. They were exhausted. Their clients were losing houses. We need more inventory. That's a beneficial thing.
It is interesting how it's like almost straight across the South. Like you got the North and then you got the South.
What's interesting is those Sun Belt states, right? So those were really big beneficiaries during COVID. There was a lot of migration going into that Sun Belt, which is all those states in the dark that you see. And the more craze that you had during COVID, the more impacts you're actually feeling it now, because it's almost like that demand was pulled forward. And again, now you have to kind of equilibrium it out a little bit as well too. And so as big as if we looked at what this looked like in COVID, what you'd see is the Sun Belt states really being impacted really low. And what's happening is now that market has slowed in a lot of the Sun Belt states because it was so heightened during that 2021 first half of 22 period.
Yeah. You can see all the Californians came to Colorado.
I was going to say, I remember all the articles about Californians going to Texas, Californians going to Colorado, going to Arizona.
Idaho was a big beneficiary during COVID as well too.
Yes. Yep. Now, and a lot of those navy blue states are also, many of those are favorable to development. Is that another part of this where there was just more housing being built?
Texas and Florida, you saw a lot of businesses moving there as well too.
Yes.
For income tax reasons and other things also like that. So there was a big influx of businesses, and that obviously creates jobs, creates migratory patterns for employees to follow as well too during that period of time. Absolutely. Yep.
Interesting.
And then you brought up foreclosures, and I'm glad you did say.
Yep.
That's the other thing that happens a lot too, is they will only show this chart from the third on the right?
Yes.
Oh my gosh, since Q3 of 2020, foreclosures are up 150%, right? Yes. And what they don't tell you is that in 2020, there was actually a moratorium where almost every foreclosure in every state was not allowed. Like you were not allowed to foreclose on a property because there were moratoriums on them and stuff. And so again, let's go back to 2005. So this is pre-great housing recession.
Yes.
And you can see we're not even at those levels. We're at about a normal level. There are going to be foreclosures. There are going to be people that own a home and they've lost their job, or they've had some catastrophic life event that happens where they can no longer afford it. And so we are going to always have a level of delinquent loans and a level of foreclosure and distressed property sales that happen within the US. But we, as you can see, we are very much in a normalized range and not anywhere close to what we were seeing build up to the Great Recession or during the Great Recession or even thereafter. And so very much in a normalized range, not something that you don't ignore it. We obviously pay attention and we watch it. But the lending standards are also very different today, as all of you practitioners know, as you walk your consumers through working with Prosperity and you get them approved for a loan. It's a very different lending environment than it was, let's say, in 25, 26, 27, leading up to that period of time, where it was, let's say, much more generous on, they're fucking at me here, I get it, or just much more generous on who would qualify for a loan. We're actually have standards now moving forward and stuff. And
Yes.
and the reason why, so why would be another reason foreclosures are going to be fairly low? A lot of it is because of the equity in the properties, right? So if I did have a job loss right now, or I had some kind of medical event where I need to sell my property and I can no longer afford my mortgage, what more likely is going to happen is I'm going to be instructed to hire a real estate professional, sell my house, pay off the mortgage, and take my equity with me to wherever I go next. There's not as many people, unless you bought very recently and then have this catastrophic event happen in your life. Most people are sitting on a lot of equity and you just don't have a reason for a short sale. And I can tell you, as somebody who represented banks in the past, they don't really want to foreclose on properties. Banks don't like having properties on their books. And so they will avoid it at all costs, which is why more often than not, if you've got equity, you're just going to sell your property and move out of it at that point, as opposed to having to go through a distressed sale situation. And so you can see the equity across the country. And I mean, man, look at California. Average equity, almost $600,000 in a home. And Colorado, not too far behind there as well, too. So Gretchen, anything you want to add on the equity side?
No, I think you hit it.
Okay.
Yeah, in California, you can almost draw a vertical line splitting California into two halves, and there would be $1 million split on that average, right? The 569,000 would be on the east, and $1 million minimum.
Yeah. You probably have 4 quadrants, because you could also then north-south.
Yeah, that's true.
Yeah, Central Valley, I'm guessing, looks a little different. Yeah.
And that brings, at least to my mind, in terms of the inventory problem in California, because so many people are sitting on so much equity, selling their home, even with the tax exemption right now, there is a tax consequence for people.
I'm glad you brought it up, because I did see that the president of NAR said that's the next, now that they've got the 21st housing bill passed, that is the next thing they're turning to, because you're right on, right? If you look at California, even as a married couple,
yes,
the tax exempt limit for married couples is $500,000. Hasn't changed since 1997. That means the average person is $96,000 over that, which means Uncle Sam is going to take, almost 15,000 of that 96,000 as a capital gains gain, And so we really want to have that exemption raised, because we feel like we don't want to have anyone who would think about selling right now, not selling because of the tax consequences. And they're like, well, it's just better if I stay and pass it when I die, because there'll be less tax consequences. That's not how we want people making housing decisions. And so hopefully we can see another very bipartisan effort behind raising that exemption that has been in place since 1997. Which
that opened up a lot of inventory.
Right. In our footprint here in San Diego, there's a community here called Carmel Valley. And so some of the first wave of homes that were built in this community just east of Del Mar, it was kind of the production affordable portion of Del Mar that was developed, right, just east of the 5 freeway. Started off in 1985, roughly, and they were selling those homes at that time in the low 200s, 220, 230. Many of those people are living in these homes still today. They're nearly $3 million today, right? And so a number of those people cannot sell. They can't afford the tax consequence of, even with improvements and everything like that, maybe you can get to a tax basis of, I don't know, maybe $800,000 at most. I mean, the tax consequence on that is just astronomical, and they're just handcuffed there. And they also can't afford to live anywhere else as a result of it, right?
Yeah, it will disproportionately hit baby boomers and those aging in place more so, because another kind of little known fact here is that if my spouse would pass away, if I stay in that property for more than 2 years after they pass, I now drop down to the single exemption limit, which is
Yes.
250,000
250.
as opposed to 500. And so there are some unintended consequences that are coming if they don't address it, which I hope they do.
Yes.
This is just looking at equity in just another way. Like you'll hear a lot about there's record amount of mortgage debt right now, but you can see the total value of the residential real estate and then that $34 trillion of real estate equity. And so again, another reason why distressed property sales would be down, because there's just a equity that we have in our homes than debt on the properties. You can see, we can go back to that 2007, 8, 9, 10, and you can see that yellow and blue line were inversed at that point, right? And when they were inverted, that's when you have a lot of short sales, a lot of foreclosure properties, because the debt is higher than the value of the property. And you can see the gap now as we're in 2026. This is the one thing, that when Gretchen talked about, the people waiting for a crash, this is another one that you can show them to say that the numbers just don't, the math isn't mathing right now as far as to those types of circumstances to come about. And so, we talked about generations. I just mentioned baby boomers and stuff. And so really about 40% of that equity is held by the baby boomer generation. They are our largest set of homeowners right now still. And then you can kind of see where it's spread out between Gen X and then millennial. What we really want to see happen over those next handful of years is millennial really start coming up, and then Gen Z start coming up in that as well too, as we start seeing that transfer of wealth and transfer of equity from these different generations. And Sam, you brought it up, and Gretchen, please touch on this as well too. To your father's point of why is it you want to tell someone to buy a house the second they can afford it? This is the one that always stands out to me.
Yes.
This is the average homeowner versus the typical renter, and you can see their median net worth. If you look from last year's numbers, about $430,000 was the median net worth of the typical homeowner. The typical renter had about $10,000 worth of net worth. That is the power of home ownership and wealth building as well too.
What are you going to have a chance, Chris, to talk on what I know you said during the housing crisis, the real housing crisis, when you talk about delayed getting into the housing market to a later point in your life and how that has an impact on your accumulation of wealth over your lifetime?
I did add a few slides. I hope you guys are okay with that. So here's what you're referring to. So this is what happens when you wait. So if you buy a home and you become a buyer, let's say by age 30, right? You become a homeowner by age 30. By the time you get to 50, that wealth gain that you have is about 22.5% higher than if you didn't do it, if you weren't a homeowner by the time you get to 50, right? If you wait until let's say you're mid to late 30s to do it, that 22.5 gets cut now to 11.2%, right? So it gets cut in half. And if you become a late stage buyer, like you don't buy that first home until you're more 38 to 42, that difference between a homeowner at that age versus a renter at the age of 50, you're only getting about 1.5% gain. And by after 43, there's really no gain at all. So that is the impact of delaying, and why when, Sam's father, I mean, like the hero of the day, is like you buy the home the second you can afford it, because it is an engine of wealth creation. And the sooner you start that engine, the more wealth that is created over the course of your lifetime, not just in that single home, but as you roll that equity into the next house, into the next house, into the next house.
Show that to all your buyers that are under the age.
I'm going to show it to my father, actually.
Your son's running around here. Show it to him.
Yeah.
Well, and this is where it really stands out, right? Because if you look at by age of 28, almost 45% of all baby boomers were homeowners by the time that they were 28. Gen X, which is what I fall into, the forgotten generation, the nobody cares generation, about 42.5% of us were by the age of 28. And then millennials was 38. So you can see this kind of steady decline of part of it is family formations, right? People are waiting longer to get married and have kids. Those are the two biggest drivers of buying a home. But part of it is the affordability challenge that we're obviously seeing as well too.
Yes. I think being able to convince also a younger generation that buying anything, like literally anything, any real property, is going to be so much better over the long term than waiting for the most ideal circumstance. And I think that's a big challenge. I have talked with and consulted with nieces and nephews, and living too far from the coast based on where they're currently renting and able to afford is painful for them, right? But being able to buy whatever you can afford, wherever you can afford it, is that first step, right? It just is.
Yep. And then here's just showing, for the different income brackets, how much of their net worth is made up of equity versus other investments,
Yep.
And so you can see the lower the income, the more important actually owning that home is as far as driving.
Oh, that's a great point. That's a great point.
Yep.
Wow. That's amazing.
And then this was the one that I found a little scary that really, I think, was kind of the kickoff to that white paper that we did, Brent, on kind of the American housing crisis, where, everyone over the last year and a half has been screaming about seller choice. And again, we won't get into a whole private listing network debate today or anything like that. But what the point would be is that, really over the last 5 years, it is not the sellers that have been harmed. But this is the stat that really scared me. So they do a question every year, Gallup does, where they ask non-homeowners, do you see yourself being a homeowner in the next 5 years? And what you can see happen is from 2013, it was, almost half of those people would say, yes, I see myself being a homeowner in the next 5. You got to 2018, pre-COVID, it was 41. You get to 2026, and now only 19% of non-homeowners see themselves as a homeowner in the next 5 years. Now, the good thing is that you would think it just means they don't care anymore. Like, I'm never going to be a homeowner. They still say yes at the same rate they always have. They've just pushed the runway. Now you got to get out 10 years. So to get back to that kind of 30% where they say, yes, I do, you got to get out to, like, in the next 10 years, do you see yourself being a homeowner, as opposed to 5? And so the dream is very much there. Like, we have not crushed the American dream. There's just some inherent challenges around it because of the affordability issues that we have. And there's a lot of different ways to solve it. There's not one magic pill. The 21st Housing Century Act it's a long-term fix, more inventory, more houses, more, let's say, regulated home price appreciation in the coming years so that wages can keep up with it, transfer of wealth from baby boomers down to the next generations of that home equity. There's a lot of different things that will go in to fix it. The good thing is that the dream of becoming a homeowner is still very much alive, and it's still a central part of even our young folks out there, and from younger millennials to Gen Z, and then hopefully Gen Alpha after that as well.
Yeah. Well, what the takeaway I have from this slide, Chris, is if the dream is still alive, but they're more pessimistic about it, that makes our role as realtors even that much more important.
1000%. Because there's still, and Gretchen, you work directly with the people. No matter how many times we say it, there are still people that could be a homeowner today or maybe a year from now that will push it off because they're still under a belief that they can't be, right? Because, let's say they're in their mid-20s, early 20s, and they have a parent who's in their 60s still saying, well, you guys got to work really hard to save that 20% down payment. Like, no matter how many times we try to crush the myth that yes, 20% is great. It's going to give you better rates and better terms, but that's not what you need in order to become a homeowner. There's still people out there that believe it, or they haven't sat down with a professional like everyone at California Properties to find out what is my pathway to becoming a homeowner a little bit as well too. And so you're right. The working with a professional is more important than it has absolutely probably ever been at any point in history.
Yeah,
Gretchen, that was your cue to say yes.
Products. I mean, the Prosperity Home Mortgage has some really terrific products. They have a vast array of options for buyers. So, the sooner you can get someone pre-qualified with a mortgage consultant, the better, because they'll be able to tell them all of the options and opportunities.
Yeah. And I think also as an industry, though, we tend to have no problem thinking long-term in terms of relationship building, in terms of consultation, when it comes to sellers. Like, we'll have a conversation with the seller 2 years before they retire and ready to sell, and we're building that relationship. We seem to have this narrow thought process when it comes to home buyers, right? Like, if you're not ready to go in 30 or 90 days, like,
wasted time. Yeah. Call me when you're ready. Yeah.
Right. We should be having these conversations, even if you don't have the down payment today, or you can't afford it today. We should be fostering these relationships every single day, even with the sellers who are not selling right now, their children, and coaching them through this entire process, right? So, I don't know, that's just something that came to mind.
Client for life.
We're forever agents.
Forever agents.
And I think it is, it's reaching out to all of your clients that have children in that, let's say, 20-something range, and saying,
yes,
hey, would it be helpful if I ever had a consultation with your son or daughter about, what it would take, where they're at right now, maybe in becoming a homeowner, and I mean, most people are going to say yes to that, right? Like we would love for you to have a consultation with them and kind of start them on the right path to that journey. And some people might be, that path may be way shorter than what they currently think based on their circumstances and where they live, and I know sometimes that means you got to drive further out from city center in order to make that affordability, but may be willing to do that. And that was why we wrote that white paper. In addition to the mid-year, was it just feels like there's been a wrong. It's not to say that the conversation around the seller are unimportant, but the emphasis, right? Like we've been overly emphasizing one side of the transaction versus the side that really causes concern for me as we look a decade down the road, if we just continue to push off more of the future homeowners, because those are the people that become our sellers in the future as well too,
Yes.
So we got to look at both sides of it.
Awesome. All right. So before we conclude, though, I want to make sure our audience knows that how to get this report and what they can do with it. So let's pull that up. So you can access it one of a couple ways. I know that we can access it from the Home Services of America website, but you can also get it from our blog, and it's blog.bhhscalifornia. That's where you can find it. You can also find some marketing deliverables that our marketing department has put out. So what you're seeing on the screen right now is the social media product that our marketing has put together, and feel free to use those. You can customize the images in the back if you care to, and you can click through. Your consumers can use it and they'll get right to this report. Gretchen confirmed for me that you can't customize the front cover. That must stay branded to Home Services of America, please. But the back cover is able to be edited, and you can put your agent branding on the back cover, and we encourage you to do that. So, and this report is filled with all of the information that we just tried to convey, and there's much more that we didn't get to today. Fantastic graphs. I was sharing with Gretchen before we started today that each one of these pages is like a standalone post. I mean, each one of these is something that you could put out in a newsletter or a blog, and it would get your client's attention. So
now you see why we had to give Gretchen a full-time job, because she's already started on the January 27 one. So
secure her while you can. She's amazing.
Yeah,
awesome.
You know what I do on New Year's and on the 4th of July? I write reports.
It is absolutely.
Well, we're grateful that you do, because the outcome is beautiful and very relevant and very useful. And we here at California Properties thank you, and we're going to use it a ton, and we can't wait for the 2027 version. So thank you.
It's an amazing tool. And I know that Gretchen created this because she understands wholeheartedly that this is just a tool. What it sparks is the emotional intelligence that it takes to lead buyers and sellers today. And there's no one more in this industry than Gretchen that has an amazing emotional intelligence around real estate in general. And the work that you're doing, Gretchen, we really appreciate all of it.
Thank you.
Yeah, absolutely.
Okay, so let's conclude with our quote. Thank you both. I appreciate both of you. Thank you for taking the time to be with us today.
Thank you.
And we get inspiration from all different sources, so it might not surprise you that today's quote is from Jimi Hendrix.
Oh, I like it. Good job.
Thank you very much. Knowledge speaks, but wisdom listens. So to your point that you were just making, I think one of our good practitioners listens to what our clients needs. They listen to what our clients tell them, and they use then the knowledge that they get. They listen to today's episode. They're going to go back and they're going to watch it again. I know they are. They're going to access the report, and then they're going to answer their clients' questions, right? They're going to, with wisdom, the wisdom they got today.
Nicely done with the quote today.
Thank you very much.
Nicely done.
What does that mean? You don't like my quotes normally?
I'm impressed.
All right. Well, thank you very much. All right, everybody. Thank you for joining us. If you would like to remember that this episode is always recorded, you can catch it 24 hours later on Precipio, our agent development center, under the Go Live channel. And we will be here next Tuesday.
All right.
All right.
We'll
Thanks,
see you next
everybody.
week. Bye.